Press. You are welcome to the Community and Press Briefing for the 148th Monetary Policy Committee meeting that held yesterday and today, the 24th of May 2023. The Monetary Policy Committee met on the 23rd and on the 24th of May 2023, confronted with persisting and emerging risks to both the global and domestic economies. On the global scene, the key risks are the fear of contagion arising from the U.S. banking crisis, the ongoing Russia-Ukraine war, and growing tensions between China and the United States. In addition to this, the oil market has remained volatile even as global trade figures continue to decline. In the domestic economy, the major risks identified include high public debt, high inflation, declining oil production, and moderate recovery of output growth. The committee assessed these developments and the outlook for the rest of the year. 11 members of the committee attended this meeting. The global economic development. The committee deliberated on the key headwinds confronting the recovery of global growth, including the impact on global trade associated with the Russia-Ukraine war, the risk of contagion from the United States banking crisis as investors exercise caution, and the downside risk from the build-up of hostilities between the U.S. and China. Output growth recovery has thus remained moderate in some countries and subdued in others. Members noted that despite concerted efforts by the advanced economy central banks, inflation has remained broadly elevated and well above long-run objectives, with consequences for investment spending and the recovery of output growth. In the emerging markets and developing economies, inflationary pressures remain heightened amidst several headwinds. Global financial conditions have continued to tighten as several central banks maintain their push towards taming inflation. Gold prices sustained an uptrend as investors seek a safer haven asset to shield their losses downturn, with growing fears of a global financial contagion associated with the banking crisis in the US and in the Euro. Consequently, the International Monetary Fund (IMF) in its April 2023 World Economic Outlook further downgraded output growth forecast for 2023 to 2.8% compared with its January forecast of 2.9%. Growth is however expected to improve moderately to 3% in 2024. Domestic economic development. According to the Bureau of Statistics (NBS), real gross domestic product grew by 2.31% year-on-year in the first quarter of 2023, compared with 3.11% in the corresponding period of 2022 and 3.52% in the preceding quarter. The economy moderated on its current recovery trajectory, posting positive albeit lower growth for the 10th consecutive quarter, in spite of a multitude of headwinds to its full recovery. The growth performance was driven largely by the sustained growth in the services and agricultural sectors, progressive uptrend in economic activities across several subsectors, and sustenance of broad-based support by the bank in growth-enhancing sectors. Star projections show that output growth recovery is expected to continue reasonably in 2023, given the significant improvement in the composite purchasing managers index, which rose to 51.1 index points in April 2023 from 42.6 index points in March 2023. Please, let's have our phones off, please. The committee noted the persistent uptick in inflation as headline inflation year-on-year rose to 22.2% in April 2023 from 22.04% during the previous month. While this amounted to a moderate increase of 0.18% points, the recent uptick was driven largely by the increase in both the food and core components which rose moderately to 24.6 and 20.14% in April 2023 from 24.45 and 19.86% respectively. In March 2023, the lingering insecurity in major food producing areas, high cost of transportation driven by rising energy costs, activities of middlemen in the food distribution channels, as well as the persistence of shocks from legacy infrastructural bottlenecks. The MPC observed that the economy continued to be weighed down by high import bills, leading to pressure on foreign exchange and resultant increase in the general price level. The committee noted that the economy needs to build up the stock of foreign reserves so as buffer against shocks. In addition, the current trend in price development would continue to be monitored by the bank with greater collaboration with the fiscal authority to address the drivers of inflation. Broad money supply M3 in April 2023 grew by 22.11% annualized, largely driven by the increase in net domestic assets. Money market rates reflected the relatively tight liquidity conditions in the banking system. Consequently, the monthly weighted average open buyback (OBB) and interbank call rates increased to 17.05 and 15.8% in April 2023 from 14.07 and 14.75% in March 2023 respectively. The committee noted the sustained stability in the banking system, evidenced by the performance of the financial soundness indicators. The capital adequacy ratio stood at 12.8%, non-performing loans at 4.4%, and liquidity ratio at 45.3% as of April 2023. MPC noted the momentary lull in the equities market in the review period following end-of-year activities by several companies on the exchange. The all-share index and market capitalization declined to 52,403.51 and 28.53 trillion naira on April 28, 2023, from 55,806.26 and 30.40 trillion naira on February 28, respectively. Committee also noted the moderate decline in the level of gross external reserves to $34.91 billion in April 2023 from $35.14 billion as at the end of March 2023, attributable to transactions in the foreign exchange market and the largely minuscule accretion to reserves from crude oil exports. The bank disbursed the sum of 25.6 billion under the 1 trillion naira real sector support facility to 8 new real sector projects in manufacturing, packaging, pharmaceuticals, plastic and cosmetic products. Cumulative disbursements under the real sector support facility currently stands at 2.56 trillion naira, disbursed to 462 projects across the country, comprising 258 manufacturing, 95 agriculture, 97 services, and 13 mining sector projects. Whereas under the 100 for 100 policy on production and productivity, the bank disbursed the sum of 13.81 billion to 3 projects in the manufacturing sector. This brings the cumulative disbursement under the facility to 173.3 billion naira, disbursed to 81 projects comprising 45 manufacturing, 23 agriculture, 5 healthcare, and 8 services sector projects with an estimated 23,343 direct jobs created. Under the Nigerian Electricity Market Stabilization Facility, NEMS 2, for capital and operational expenditure of distribution companies, DISCOs, the bank disbursed 11.82 billion naira to ease liquidity constraints and support the recovery of legacy debt. Under the scheme so far, the bank has disbursed a cumulative sum of 254.39 billion naira. The outlook. The broad outlook for the full recovery of both the global and domestic economies remain clouded by legacy and emerging risks. Available data and forecasts for key macroeconomic indicators in the Nigerian economy suggest that the economy will continue a moderate recovery path through 2023 as legacy headwinds linger. These include insecurity in food-producing areas, high cost of energy, and rising cost of debt servicing. Accordingly, the economy is forecast to grow in 2023 by 3.03% CBN estimate, 3.75% Federal Government of Nigeria estimate, and 2.29% by the IMF estimate. The committee's consideration. Ladies and gentlemen, at this meeting, the MPC was concerned that despite the aggressive stance adopted since its May 2022 meeting, inflation had decelerated towards the bank's long-run objective. The MPC noted that the continued rise in headline inflation, albeit moderately, remained the biggest challenge confronting macroeconomic stability in Nigeria. Headline inflation, in the view of members, remained high due largely to a host of non-monetary factors outside the reach of the central bank, such as perennial scarcity of PMS and expectations of short-term hikes in the pump price of the PMS, high and rising prices of various energy sources, and a host of headwinds confronting the food supply chain. In the circumstance, committee enjoined the fiscal authorities to explore other avenues to expand the fiscal safety net in an urgent bid to improve its ability to respond to legacy and emerging shocks. Non-oil revenue sources such as the expansion of the tax bracket will enable the reduction of fiscal deficits and public debt to improve fiscal space. Confronted by these challenges, the committee tasked its Research and Monetary Policy Department in the course of this meeting to evaluate the counterfactual evidence from available data using empirical analysis. The results of the analysis revealed that following each monetary policy rate hike, the rise in inflation moderated relatively to what it could have been if MPC did not aggressively raise rates at all. In fact, empirical evidence provided showed that whereas inflation in April 2023 stood at 22.27%, the counterfactual evidence suggests that it could have risen to 30.48% in April 2023 had the MPC not taken any action to raise policy rates as it did since May last year. Indeed, the cumulative effect of monetary policies, MPC's policy rate hikes, has moderated the rise in inflation by about 800 basis points over the last 1 year. Committee was also concerned that output growth on a year-on-year basis dropped to 2.31% during the first quarter of 2023, compared with 3.11% during the first quarter of 2022. The dilemma at this meeting, therefore, centered around whether to hold or loosen in order to refocus on growth or tighten further in order to tame the rise in inflation. Members were, however, unanimous that given that rising inflation would ultimately halt growth, it is imperative to continue to focus on price and monetary stability, though in a less aggressive manner. The committee called on the management of the bank to continue to explore avenues to improve the exchange rates policy to moderate pressure on the market. Members were optimistic that the continued progress made with the RT200, Naira for dollar, and other policies targeted at attracting trade and diaspora remittances would continue to support accretion to reserves and improve liquidity in the foreign exchange market. While output growth remains on a positive trajectory, the MPC noted the need for increased monetary and fiscal coordination to support recovery in the light of the identified risks confronting the domestic economy. Members expressed satisfaction with the banking and financial system stability indicators presented to the committee. They, however, noted that the risk of global financial contagion is yet to dissipate. To this end, Management was enjoined to maintain strict vigilance to insulate the banking system from potential spillover effects. So far, the bank has sustained stringent micro and macroprudential measures to ensure that the banking system remained resilient with adequate buffers to ward off both external and domestic shocks. In its consideration as to whether to hold, loosen, or tighten, the MPC was of the view that hold or loosen options were not desirable at this time, given that a hold may compromise the bank's decision to tame the rising inflation, particularly when its in-house staff estimates have projected that headline inflation will continue to rise in the immediate months ahead before decelerating. As to whether to loosen, this option was considered undesirable because loosening in the face of persistently rising headline inflation would compound the inflationary pressure and trigger further macroeconomic instability. The committee also feels that loosening will further widen the negative real effective interest rate margin and worsen domestic financial and monetary market conditions, including triggering a naira depreciation. The committee's decision. In the opinion of members, the key policy dilemma at this meeting was either to hold or hike the policy rate marginally to offset the moderate increase in headline inflation. Considering the option of a hold policy, the committee reiterated the empirical counterfactual evidence of a do-nothing and believe that the rate hikes have indeed helped moderate the continued rise in inflation, albeit month on month. In addition, the evidence revealed that the rate hike has also helped moderate growth in new credit and reduce the pent-up aggregate demand, which had contributed to the inflationary pressures. Members were unanimous in their conclusion that the current policy stance is indeed impacting the targeted parameters and yielding the expected outcome, albeit and somewhat slowly. Reviewing the arguments to further hike the policy rate in a bid to subdue aggregate demand, members noted that the current uptrend in inflationary pressure was driven by a combination of both demand and supply side issues. The MPC observed the continued upward risk to price development driven primarily by expectations of rising energy and food prices, unabating security challenges in food producing areas, as well as persistent exchange rate pressure. The committee thus felt it expedient to continue to address the demand side issues falling within the ambit of its policy tools. The balance of the argument thus leaned sufficiently in favor of a further hike, albeit less aggressively, considering the adverse impact of rising inflation on real income. The MPC therefore opted to tighten, though moderately, to 1. Indicate the MPC's conviction that the current policy stance is moderating the rising inflation, albeit month by month, and sustaining the stance will consolidate the gains made so far. 2. Support the efforts towards moderating the demand pool inflation as cost of funds increases and discourages further build-up in aggressive demand in the face of declining output growth. 3. Narrow the negative real effective interest rate gap and moderate the associated consequences, including discouraging domestic savings mobilization and waning investor confidence. And 4. Effectively moderate the monetary phenomenon in the current drivers of inflation by tempering both economic and financial conditions and sweep up the inflationary excess liquidity in the system. And 5. Boost the bank and the committee's credibility following its earlier forward guidance to continue to tighten when confronted with unabated rising inflation. Members thus resolved by a unanimous vote to raise the MPR, but moderately. 10 members voted to raise the MPR by 50 basis points and 1 member by 25 basis points. All members voted to keep all parameters constant. In summary, The MPC voted 1, raise the MPR to 18.5%, 2, retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, and 3, retain the CRR at 32.5%, and 4, retain the liquidity ratio at 30%. I thank you all for your attention.